On a Friday to meet. I want to make sure that I have a chance to sort of go through how you know whether an industry is attractive or not attractive, what kinds of things that you analyze, and should have some time to answer any questions you have as we go through. So feel free to ask questions. And what we're really doing is sort of taking this high-level view of why some firms make more money than others. And it's either because you're in an industry, as I mentioned last time, that is attractive, and we'll define what that means, or you have a really good position in that industry because you've got a good strategy and you're offering unique value that others aren't offering. So let's just start with some data on differences in profitability across different industries. So if you look at return on capital measure for a number of industries, you can see from soft drinks, ethical drugs as opposed to, I guess, unethical drugs, tobacco, grocery stores. So they're making higher returns. Down here, it looks like on average you don't want to be a steel manufacturer or you don't want to be an airline. But on average, those companies don't make a lot of money, right? So all else being equal, you can sort of say, if I had to choose which industry I want to be in, I want to be in one of these industries. And so the five forces model was designed to help explain why some industries, why firms collectively tend to make more money in one industry versus another. And as you look at these first three actually, so my theory of attractive industries is sell addictive products, right? Because clearly, soft drinks, drugs, ethical drugs, and tobacco are addictive products. But how does that fit into the Porter's five forces model? Is that actually sort of captured in that model, do you think?
I think so.
Yes? How is it
I think
captured?
because there's such high demand, you can say there's supplier power because there's lots of demand for it. And so you have an advantage as a supplier because you can have high prices.
Yeah. Yeah, and the way they actually say it is that we have power over our buyers.
Yeah.
So we think of that actually as buyer power. So there's power over my buyers or there's power over my suppliers. In this case, I've got power over my buyers. They're not price sensitive because they are actually hooked to, to my product, so to speak. So it actually does sort of fit, this notion of, maybe, you want to sell products that people sort of got to have. They're not price sensitive. That means you got buyer power. If they're not price sensitive, they really need it. Then you've got bargaining power over those buyers, and you're more likely to make money if you sell products like that. All right, so what we want to do is we want to break down the industry structure and try and understand what drives profitability in an industry. So at the center of the Porter model is rivalry among existing competitors. And if you have more rivalry, then you're going to have lower profits. He sort of puts around that threat of new entrants and threat of substitutes. So typically, you're going to have these things actually influence rivalry. The more you have new entrants that can easily get into an industry, the more rivalry you typically have. And the more that there are substitutes, typically the more rivalry you have. Although there actually are some independent factors that also influence rivalry in an industry that we'll talk about. Then you also have bargaining power of suppliers and bargaining power of buyers. So you're trying to create a pie, and the question is how much can suppliers grab for me because they've got bargaining power. They bring inputs that I have to buy, and I can't be very price sensitive because I need them. Or to what extent do I have power over my buyers? I'm selling something, and I have power over them. They really want or need what I'm offering. So let's sort of walk through each of the five forces, and I want to start with the one that I told you last time that I think is the most important, and that is barriers to entry, or threat of new entrants. Because if you don't have barriers to entry and you have bargaining power over suppliers and buyers, then companies should enter that industry to get that bargaining power and to make more money, right? So you'll tend to see more entry. So there really should be something preventing new entrants from getting in if you want to try and maintain the sort of high profits in an industry. So think of it this way. You've got this industry here. You've got firm D who wants to get in and can't get in. Why can't they get in? So let's just sort of walk through different things that serve as barriers to entry to an industry. Let's start with actually scale economies and capital requirements. So anybody here define what scale economies means? What's scale economies?
It's when your company is able to produce at such a high scale that you're being able to cut down your costs.
Okay, so your cost per unit goes down because you're producing very high volumes.
Mm-hmm.
And in fact, what we see is that you can spread, you tend to have high fixed costs in a business that you can then spread across lots of units when you produce more. All right, and then there's this notion of capital requirements. I want to talk about the aerospace industry on both of these. In some cases, you need a lot of money to enter an industry. In some cases, you don't need a lot of money to enter an industry. So let's just talk about the aircraft manufacturing industry for a moment. How many aircraft manufacturers are you aware of? So Boeing and Airbus today are like the two big ones. There are some regional jets and smaller ones like Embraer and Canadair, but really it's Boeing and Airbus that dominate this. About 25 years ago, we actually had McDonnell Douglas. We had Lockheed, which also made aircraft. Martin Marietta was also a producer of aircrafts, or at least large portions of aircrafts. And yet we gradually saw those folks disappear. And here's partly why. The cost to develop a new aircraft, in terms of just figuring out the design of it and then building like the manufacturing plant to produce it, is about $5 billion. Okay, so you need a lot of money. This is why capital requirements can be a barrier to entry. So you can imagine if I go down, let's say I've worked for Boeing and I have an idea for a new jet. I go down to my bank, I say, I just need $5 billion to design this next jet. And I won't have even sold any yet. That's just to design it, to build the plant, to be ready to produce. You have these huge capital requirements. That creates a barrier to entry. But then, in order to make back the $5 billion, typically you need to sell somewhere around 300 to 400 aircraft. Sort of rule of thumb, given the amount you tend to make per aircraft. So for a certain size aircraft, Boeing 737 size, let's say, there are about 1,200, 1,300 planes that are sold worldwide over the life of the plane. So you're talking about maybe a 15-year product life cycle. 1,200, 1,300 planes. You need to sell 300 to 400 in order to break even. How many companies are you going to see in that industry? Not too many. It's hard for there to be 4 players, because for 4 players to each sell 300 to 400, that means they'd all be breaking even if they were each selling 300 to 400. Does that make sense? So what we've seen over time is that we've had fewer and fewer players in the industry, because you need to be able to produce more than 300 to 400 planes if you're going to make money with any given product. That's how economies of scale could be a barrier to entry. So in some industries, you have to look at the total volume in the industry, and then you got to look at, well, how many units are we likely to have to produce in order to be able to produce at what we call a minimum efficient scale. The minimum efficient scale, we'll talk about more, you'll read more about this with the cost section. It's basically looking at cost per unit, and as you see it come down, you'll see that it starts to flatten out and then go up. It's a scale curve. And at that point that it starts to flatten, that's the minimum efficient scale. And if that number is like 300, if you have to produce 300 planes and there's only 1,200, there's only going to be a small number of players in that industry, because you can't get enough scale in order to survive, to build plants, to produce your product. And so you tend to have few players in that industry. And it becomes a barrier to entry. You don't want to enter that particular industry because it's too risky and you have to get too many planes. Okay. Whoops. And capital requirements, as I mentioned, can also be a barrier to entry. The more money you need to enter an industry, then the less likely you are to have new entrants, because it's hard to raise that kind of fund, that kind of money. Let me also talk about scope economies. So economies of scale mean that you lower your cost per unit because you do the same thing over and over and over again. Whether it's making a Boeing 737 over and over again, or a particular motorcycle, but you do the same activity over and over again. That's what we think of as economies of scale. Economies of scope mean you sort of do related activities, that somehow, by doing two activities, it lowers the cost for you because you do two activities that are in some way related. Let me give you an example. In the United States, where do we mostly shop for clothing? Malls, right? We mostly shop at malls. So now the question is, how do retailers get space in a mall? How's that? Leasing. They've got to go and they've got to be able to lease the space. Now, have you noticed how the malls have been becoming more and more alike over the years with the same stores in the malls? That's because big companies, some of them will actually own multiple stores in the malls. So, like the Limited, the company The Limited has, over the years, and then they've bought and sold some of these stores, but over the years, they have owned a number of different kinds of stores in the mall. For example, they own Limited, Limited 2, Express, Structure, Bath & Body Works, Victoria's Secret, Lerner, Lane Bryant. Those have all been sort of in their portfolio of stores and brands that they offer. How might that create a barrier to entry for a new company wanting to come into selling clothing, or even Bath & Body Works, or in a mall? What do you think? How could that help them stop another firm from coming in?
Because all of those different stores that sell generally the same thing, but with some variation. So whichever store is entering, they're more than willing to lower the prices to undercut them, but even take a loss because they have all these other stores to float them during that time.
Okay.
So they can suffocate out them.
So one option is we can be aggressive in one particular market or area, and we can make it up other places. Okay, so that's one way. Yes.
So if let's say 40% of the mall is owned by one company, then just the number of the space that's left over for other companies to get with. I mean, you reduce the supply and prices are going to go up. It's going to reduce the number of competitors.
Right. Think about if the Limited's going in, or the Gap, or others that have multiple. If they have multiple stores and they're going to negotiate with the developer for rent, if I can bring you 8 stores, you think I'm going to get a better rent? Absolutely, right? So now, not only do I get in early, do I get better rent, sort of rental prices, but I also am likely to get preferred positions in the malls. And what that effectively does is becomes a barrier to entry for someone new trying to get into the industry, because they are going to have to pay higher rent because they don't have the scope of operations, the number of different store formats, and they also are unlikely to be able to afford the higher rents. The other thing is, think about distribution out to the mall. Now we could have a central warehousing, and we could send a truck, and we could have clothing for multiple different of our stores on the same distribution truck. Or we can give, the other thing is we can give coupons out. If you go out to the outlet mall or other places, sometimes you'll buy at one place and they'll give you coupons for other places that you can buy. It's because they're often owned by the same company. So now you get these cross-selling opportunities that occur. All of that, the scope of operations can now produce a barrier to entry for a new entrant. Does that make sense? Any questions about that? Okay, so that's the way scope economies works. Switching costs, some products inherently have switching costs. Software is typically one of those. Compatibility issues around switching costs, you've learned how to use a certain kind of software, whereas most of us can change our brand of gum without huge switching costs, right? Or different candy bar, whatever it might be. Products that have these inherent switching costs where there's learning involved, where there's investment involved, those products tend to have barriers to entry that other products don't have. That's one of the reasons why software actually tends to be a very attractive industry generally. Because once you get a set of users, there tend to be switching costs, which makes it harder for new entrants to pull away. Access to scarce resources can be a barrier to entry. De Beers, company that sells diamonds and actually now has diamond stores. But basically by trying to own diamond mines, they've owned a lot of the scarce resources that you need in order to be in the diamond business. And that creates a barrier to entry to somebody else because there are only so many diamonds and diamond mines out there. And if De Beers already owns it, it's hard to get into the industry. The learning or experience curve. So we've got here, I've got Honda and motorcycles. We'll do a case a little bit later on Harley Davidson, but Honda, by producing millions of motorcycles, is able to bring down their cost per unit. And it's a fairly steep experience curve, which means with every doubling of volume, their costs drop fairly significantly, 20, 25, 30%. Well, that means for a new entrant to come in, if you're going to produce motorcycles in the same way or a similar way, you're going to get a huge cost disadvantage because you just don't have the volumes to get in. So learning curve or experience curve can be a barrier to entry. Product complexity can be a barrier to entry. Like Intel, we'll do a case on Intel on Monday, but microchips are they're a complex product. And so it's hard, there are fewer people that can figure out how to run a microchip company than there are that can figure out how to run a grocery store company, let's say. So in fact, you're going to have more supply of people who can run certain kinds of businesses than others. So really complex businesses, a lot of times there will be barriers to entry because you got to have people that have the analytical horsepower to figure out how to run that kind of a business. And then finally, you could have entry-deterring regulations or tariffs that could prevent entry into a particular business. So tariffs are what the U.S. government puts up in some cases to prevent foreign companies from coming in to a particular market. They also have had regulations. For example, tobacco. You can't run an ad on TV for a tobacco product. So in some ways, that's actually been good for the existing tobacco companies because that means new companies can't come in and really enter and advertise on TV. And now there are reasons why the government doesn't want advertising on TV for any tobacco at all, but in some ways it does protect the incumbents. Sorry, was there a question?
Yeah. What's the difference between scale economies and the learning curve?
Let me save that for our discussion on costs.
Okay.
But the short answer is the learning curve is about costs going down with volume because you learn how to do things better. The scale economies are more around costs coming down because I can build a bigger plant with equipment that can handle more volume. And then I can spread those fixed costs across more units. So one is more around spreading fixed costs and investment. The other is more around actually learning how to do something better. Okay. All right. Let's go to threat of substitutes. So here we have a little bit different situation. We have industry here. The customers are here. Firm D doesn't actually try and enter that industry in the same way. They actually try and access their customers in another way, through a substitute product. Sometimes you try and do it very directly. So if you think about diesel versus gas engines or direct TV versus cable, those are substitutes, but they're really trying to provide almost the identical kinds of value. And then a lot of times they're viewed as being sort of direct substitutes. Sometimes they're a little bit farther away. You think about when Virgin, or when we think about different kinds of companies entering the beverage industry, like when Red Bull came in and started with energy drinks. Coke and Pepsi, they didn't have energy drinks. but people were starting to buy the energy drinks instead of a Coke or a Pepsi, right? So they were substituting one for another. When we go out for entertainment, we could choose to go to a basketball game or a movie or a concert, and those actually are all substitutes, and more indirectly compete with each other. Okay? So one of the things that you like to try and do, if you can, is you want to try and be your own substitute. So what we've seen is like Starbucks acquired Seattle's Best Coffee. They developed partnerships with both Barnes & Noble and Borders when Borders was around, selling Starbucks at Barnes & Noble and Seattle's Best at Borders, because it really didn't matter whether you bought coffee from their perspective at Barnes & Noble or Borders, because either way you were getting their coffee. They were their own substitute. We see this with Coke and Pepsi, getting into water and energy drinks and any kind of beverage you can think of. They want to be their own substitute. Yes?
Is that also like Apple, like doing market segmentation? For instance, you could have very high-end products, and then you go to cheaper products for the group that substitutes the higher end for something.
Yeah, so it's sort of like, being sort of having this sort of broad line of products. I think that you also though have people that do tablets versus laptops. So let's say you are those tend to be substitutes for many people, a laptop versus a tablet, but they're different products. And so Apple's in both. Dell is in laptops. They haven't been very successful in tablets. But you can imagine they'd want to be successful in tablets because tablets are substituting a lot for laptops. Right? So we tend to think of it more as related product categories, but not just, maybe not just, a family of products that do this sort of the same thing. All right, let's talk about rivalry. What influences how much rivalry there is in a particular industry? Now there's some cases where it just seems like the competitors just really hate each other. Whatever the leaders of the companies, for whatever reason, they see this as a war, and they're out to put their competitor out of business if they can. In some industries, there's just more rivalry than others. There are some things that tend to promote more rivalry. So here we have an industry, and you've got competitive rivalry can focus on a lot of factors: price, quality, technology, features. There are a lot of different ways that we see rivalry play out. It could be being very aggressive lowering price. It could be lots of advertising and promotions, sort of trying to get new generations to the market much more quickly. There are a variety of ways that can happen. But here's some factors that influence whether or not there's a lot of rivalry in the industry where you compete. One is number of direct competitors and substitutes. So basic principle. Typically speaking, more competitors, more rivalry. It's harder to keep track of 5 competitors than it is 1 or 2 competitors, and what they're each doing, and what their pricing is, and how much they're advertising. So you tend to get a lot more signaling and sort of tacit collusion that goes on when there are a few companies. So if there are 2 or 3, it's just you tend to have less rivalry than when you've got 5 or 6. Coke and Pepsi, it looks like there's lots of rivalry, but they're both making a lot of money, right? So yeah, they want it to look like this is, there's a lot of rivalry, and they do spend a lot on advertising, and they spend a lot on promotion, but there's not as much rivalry as you might think. Industry growth rates influence rivalry. Yeah.
Well, so if we were talking about a measurement of rivalry, how does that work? Because if you have an industry that's like homemade mittens or something like that, where there's maybe hundreds and hundreds of competitors, how would you say that is more rivalrous than Pepsi?
So the expectation would be the more companies in the industry, the lower the average profitability in the industry. And that would be, you could test that assumption. That has been tested in a large number of industries and shown that there's a correlation. It doesn't always hold true because there are other factors that might influence the degree of rivalry. But on average, the more companies in an industry, the lower average profitability. That would be one way to think about measuring. Another way would be industry growth rate. So the question is, does high growth lead to more rivalry or less rivalry? Okay, so more, less, Could be either, actually. So if you go back to when I started working at Bain, 1984, the standard answer to that answer was low growth leads to higher rivalry. And the standard reasoning for that was, if I've got low growth in my industry and I want to grow 10%, I have to take market share from my competitors. And that's going to lead to more rivalry if I want to grow. Either that or I just have to accept low growth. So we tended to expect more rivalry when there was low growth. And then all of a sudden, we learned about markets that have what we call network effects, where they're kind of winner-take-all markets, like eBay with auctions. It's like when I want to go buy something online, people wanted to go to the site where there were the most options. Well, because there were the most sellers on eBay, that's where the most buyers went, and because the most buyers went there, the most sellers went there, and all of a sudden it becomes very much this sort of almost winner-take-all market. So if you go to Japan, do you know the market leader in auctions in Japan? It's not eBay. Yahoo. Yahoo beat eBay to Japan, just like eBay beat Yahoo in the US to build the customer base, and then it sort of dominated the market. But Yahoo beat eBay in Japan, and so they are the market leader in auctions in the Japanese market. So in a market where if I can be first and I can grow my install base, and then people have a motivation and incentive to stick with me because of this network, I'm part of this network that's valuable. So Skype is another one that has a network effect. Once I decide to use Skype, I've got to tell other people to download it if I want to call you, right? So I pull other people into their network. And then of course if it's free, then there's not a lot of incentive for people to switch, unless there's like a better product or an easier to use product out there. So in those cases, actually, we find, if it's high growth, we actually find there's a lot of rivalry early on, because you're trying to get that installed base. You're trying to get the lead so that the network effect can kick in your favor. Does that make sense? So normally, we would expect low growth to lead to higher rivalry. But in high growth markets where there's network, where there's real first mover advantages, to think about this more broadly, there's first mover advantages. By being first, you have some real advantages. Then we often see very high rivalry. People are almost giving their product away early on, especially if it's a digital product. You just want to get people to use it so that they'll be part of your customer base, and then that will help you win later on. If you have higher exit barriers, do you think you have higher rivalry or lower rivalry?
Higher.
Higher rivalry if you have high exit barriers. Now, what creates an exit barrier? Yeah, specialized capital investment. I'll give you an example. I learned about this, actually I was working at Bain, working with a client, Maryland National Bank. We were looking at trying to improve the profitability of their loan portfolio to middle market customers. As we went through the loans that they had made for facilities, I noticed that when they loaned to a bowling alley operator, they required personal collateral behind the loan. So is this just discrimination against bowling alley operators, or is something else, bowling alley operators, or something else going on? What do you think? Why do you make, if you don't make someone who's, an accounting firm, they don't have to put personal capital, but if it's a bowling alley, I want your house if you don't make the payment on your building.
So a bowling alley, I can, once it's built and already made, somebody can just come in and turn it into some other bowling alley. So there's not a really high exit cost for them. And so to incentivize the bowling alley owner to work hard at his business and not default, that they
want their backup.
Collateral.
Agree, disagree? What do you think? Yes?
So an accounting firm, if the accounting firm goes under, you can just use the building for any other type of firm, but a bowling alley can't really be converted into anything else, like not even a grocery store because it's not specialized. So they want to protect that.
Okay, so if you're a bank, if someone gives you back a building, would you rather get that accounting building or would you rather get the bowling alley? The accounting building, because it's probably redeployable to another use. The bowling alley, these guys failed because it didn't work as a bowling alley. Do you want a bowling alley that's a failed bowling alley? Probably not. It's specialized use. How do you get another firm to say, oh yeah, I want a bowling, I'm going to turn my offices, I'm going to use this bowling alley. You know, that'd be some pretty funky offices. If you got someone who wanted to turn a bowling alley into office space, it's very specialized use. That means you have, bowling alley operators are going to hang in there as long as they possibly can because the building isn't worth much if it's not used as a bowling alley. Whereas if I bought another building or I'm leasing a building and things don't go well, I can exit pretty easily because it's redeployable to another use. If I own the building, in fact, it's maybe more valuable to me to turn around and sell it to somebody else who can use it. Does that make sense? So when it's very specialized equipment or facility, then companies want to stay in. This is why steel companies hang in there as long as they can. I mean, what else do you use one of those big blast furnaces for if you're not making steel, right? I mean, they're very expensive, very specialized equipment. So you find companies hang in there, and that drags down the profit. It creates rivalry for everybody because they're hanging in there. And when you think about fixed costs, when you tend to have more rivalry when you've got fixed costs, because now everybody's trying to spread these fixed costs across the volume. That means we're all going for volume, and that's a problem. If we're all going for volume, that's going to increase rivalry because we're all trying to spread the fixed costs of our plant equipment. And we see this in the auto industry all the time. You get an economic downturn, boy, their prices drop. The best time to buy cars is in an economic downturn because they want to keep their factories running, they want to keep their machines running, so they got to sell sort of a minimum number of cars. And finally, lack of product differentiation increases rivalry, not surprisingly, and a lack of switching costs increase rivalry. If it's easy to switch to another product, then you're going to see companies trying to steal customers. But if it's hard and there's switching costs, if there's product differentiation or switching costs, then I'm not sure it's worth my investment to go and try and steal customers away from me. Okay? So now, this gives you a sense for the kinds of things that will actually increase the amount of rivalry in an industry, and again, higher rivalry means less attractive on average. All right, now let's turn to the bargaining power question. So we want to have bargaining power in attractive industries over buyers, and we want to have bargaining power over suppliers. So what can be done to neutralize the bargaining power of buyers? Of those, so this would be neutralize the buying power of those buying our product. One is, of course, you want to try and differentiate your offering so that it uniquely meets that buyer's needs. Okay, so of course we're trying to do that. Buyers have less power when your product offers something that's unique. Sometimes that's difficult to do. Another option is narrow the options of the buyer through market consolidation or exclusive alliances. So one thing you could try and do is you could try and buy up competitors so that there are fewer companies, fewer suppliers, and that's going to give you more bargaining power over your buyers because they now have fewer options where they can go for a product or a service. Third is trying to create switching costs for your buyers. And you can do this, sometimes this comes through learning, as we talked about with software, but you can have loyalty programs that you create, frequent flyer programs, try and build in points, those kinds of things will get people to go back to a particular provider of a product or service because they feel sort of locked in a little bit. There's more benefits because they've built up all these points in this type of loyalty program. All right. Or the flip side of it is what can we do to neutralize the bargaining power of suppliers? And in the same way, you could narrow the sell options of the suppliers. So again, you can acquire other companies so that there are fewer companies that they can buy from. And now you are likely to have more bargaining power over those suppliers because they just don't have as many buyer options. You could develop alternative sources of supply. So you'll read in the Intel case that Intel and the other computer manufacturers, early on PC manufacturers, always wanted at least a second source of supply. They wanted multiple sources of supply so that Intel wasn't the only one providing the chips. And that helped give them bargaining power. But Intel was trying to go the opposite way. They were trying to get rid of alternative sources of chips so that they could be the sole supplier of their type of chip. You can align with a supplier, a particular supplier, and encourage that supplier to make investments that are specialized to your company. So for example, Toyota and Nissan have with some suppliers like Toyota Bushiko, it's a seat supplier. They actually have built a conveyor belt that takes the seats from their plant that they've just manufactured and it takes them directly into the Toyota plant. So they build their plant next door and then they build a conveyor belt to take the product into the Toyota plant. So Toyota, they don't have to put them in trucks and they don't have to ship them in. It really lowers the costs of transportation and inventory. But think about it. Once that supplier's built the plant next door and they've built this conveyor belt, what if Toyota decides they don't want to do business with them? What do you do with the plant and the conveyor belt? That's a pretty specialized investment. We think of that as customized, specialized investment. If you can get your suppliers to make those investments, that's good. Because that means in the future, they're going to be more committed to you, and you're going to have more bargaining power because they've made that kind of investment. So that's something else you can do to try and gain bargaining power. And the other thing is, it's sort of like developing alternative sources of supply. You can diversify your product offering to diminish dependence on any particular supplier. So when we look at Intel, they've been very powerful in chips, but or for PCs, for computers. But for companies that have diversified and gone, Samsung makes a variety of different kinds of devices, both sort of laptop types of devices, but also phones. But with phones, they actually buy mostly from ARM, so it's not Intel. So that actually diversifies away their sources of supply, and they're not as beholden to Intel, and Intel doesn't have as much bargaining power because they're using different suppliers for different kinds of products. All right, so now we're going to get to this is a mini case. So a few years ago, when I was working at Bain, we were working with a client, and we were working in sort of this industry. We'll call this sort of set of adjacencies in an industry. So farmers grow food. Frozen entree makers purchase the food. They then manufacture the frozen entrees, and they then sell those to food retailers, and then we go in and we buy the Swanson, Stouffer's, Healthy Choice, different kinds of frozen entrees from grocery store chains. If you look at the return on equity, ROE, for farmers, the majority of farmers are in the 5 to 10% range return on equity. Majority of frozen entree makers are in the 20 to 25% return on equity, at least at the time of this. And the majority of food retailers, 8 to 12% return on equity. All right, using the 5 forces framework. I know you don't necessarily know anything about this particular industry or business. Can someone guess, hypothesize, why frozen entree makers make more than farmers or food retailers? Why is there the more attractive industry? Yeah, Phil?
Input costs are low because it's just food, but they can differentiate their products by saying this is more convenient, this is more, it's just, there's a higher margin, a big markup.
Okay, so the first point you made is this product is hard to differentiate.
Yeah.
It's hard to differentiate your corn, your beans, your whatever it might be. And therefore, it's maybe a little more commodity-like going to these folks. And yet what they're making is a little more differentiated with retailers and with end consumers. Okay, good. So that's one thing. Yes?
There are few frozen entree makers, and there's like a lot of farmers and a lot of food retailers, so they have a lot of bargaining power over their suppliers and over their buyers.
Okay, so whenever you see a few players here, lots of players here, lots of players here, in the language of economics, it's an oligopoly taking advantage of a fragmented supply base and a fragmented customer base. Now they can consolidate, and we've actually seen consolidation here with Walmart in particular coming into this part of the business. But basically, we would expect them to have bargaining power over both their suppliers and their buyers because there are just a lot fewer of them. Good, okay. What else? What else do you think might explain higher profits for frozen entree makers? So we got the bargaining power story. Yes?
There's probably a lot more barriers to entry with producing the food because you have to cook it, package it, and export it.
Okay, so barriers to entry, and I've told you, if you see really high profits, think barriers to entry. So you're thinking that somehow it's harder to jump into this business and create those frozen entrees and sell them than to jump in here or jump in here. Let's try and push what exactly those barriers to entry might be. So you think it's hard to build a plant that actually brings in the food and creates the entree?
So you have to assume that there's a lot more capital going into that.
Okay, so there's a lot of capital. So there could be more capital here than you would in a grocery store or farmer. What else? Yeah.
Yeah, specialized production lines, and then also if they're frozen entrees, I don't know how the whole process works, but you might have to transport it frozen. So the transportation cost to have a frozen truck.
I think you will have to transport it frozen.
Yeah, so I don't know if that's
Unless you want big liability issues of selling products that are likely to make people sick.
Yeah.
So you actually have to transport it frozen.
So if that's something you can do or outsource that, but you have to make sure the pH levels are all the same. Shipping and everything.
Okay, so think about, what did you estimate was the cost of a new beverage entrant to have nationwide bottling?
$1 million a spot.
How much was it?
Was it $10 million a spot? Or $1 million?
Well, that's for a slot, to get a slot. So we'll get to that in a moment. But I'm just thinking about what was the cost of building your bottling network?
I feel like it was like $100 million.
100, yeah, so it was like, but that was per plant. And then you needed it for the whole country, nation, right? Most of you probably came up with around $750 million for 5%, right? Or somewhere up to $1.5 billion if you were going to try and get up to that 10% and do it on your own. Think about how much more it's going to cost you if you now have to have this a refrigerated trucking system to get it to the stores. Okay, it actually increases the cost. I had a team look at this by about 50%. It's going to cost you a lot more to have a refrigerated system take it from your production plant to all of these grocery stores around the country. Now think about the cost of getting that slotting. Is it going to be more expensive or less expensive to get it in the freezer versus on the shelf? It's going to be actually a lot more expensive to get it in the freezer because there's a lot less space, and this, it's very expensive for the grocery store. So the big barriers to entry here are actually partly the specialized equipment in the plant, but it's more to build that network. So that's why Green Giant jumped into this, because they were already doing frozen vegetables. So they figured they could do frozen entrees because they already had that, and they already had the relationship with the retailer where they had space in freezers, in grocery stores. So the big barriers to entry here are distribution and shelf space. It's just very tough to get in. Once you've got that, someone could get in and they could actually make the entrees. There's an investment. I think it's $50 million for a plant, $50 to $75 million for a plant. There's one over here in Springville, I think, for Stouffer's. And there's some specialized equipment, but the real big barrier to entry is how do I, once I've made it, how do I actually get it to the grocery stores and sell it on the shelves? Okay. So, and the other thing is there's a brand issue too, right? I mean, are they going to buy Jeff's Budget Gourmet? I don't know how I brand it, but I got to convince people to buy this because this is a product I want you to buy. But now I've got to invest in brand too. Yeah.
Well, if you have the distribution network that's large enough, then it's justified spending a lot on advertising, which further prevents entrants from coming in if you have to compete with a $100 million advertising budget as opposed to a $1 million.
Right. Absolutely. All right. So. Yes?
I was going to say that Niagara Foods, one of the reasons that they can do with Banquet and Birdie Calendars is because they already have the plants and they know what to do, they have the relationships.
Okay, so you're talking about Niagara Foods, and you mentioned which lines?
Birdie Calendars and Banquet, frozen.
So those are their lines. I think they have, do they do Healthy Choice too? They might do Healthy Choice, I think was the other one. Niagara was here 20 years ago. They were not here. They were not here. And then what they did is they looked at this and they said, that looks a lot better than this, right? So when you think about options for growth, diversification, and this is strategy. You want to grow into areas where you think you can be successful and make money. They're looking at this and they're saying, boy, this looks pretty darn good. How do we now build a network to get to stores so that we can, instead of selling the undifferentiated products that go into frozen entrees, we can actually sell the differentiated products and make a lot more money. And that's what they did. They forward integrated into this business here. And they've been more successful making money here than they are actually in their farming business. That's how it can be useful for strategy. Yes?
I was going to say, maybe farming is similar to the bowling alley buildings, in the sense that you're heavily invested in the equipment and all that stuff that you have. And even though you're not making a huge return on equity, those machines are expensive. So it's difficult to just exit.
Yeah, I think it is difficult to exit because of your investment in the equipment and your land. Right, so you want to sort of stay in the business. All right, so pretty good job. You can use this framework as a way to sort of figure out, well, where might, why might this industry be more attractive than another industry? You now have a place to start. So this is the value of a framework. When I asked you the question like last time, I said, tell me why soft drinks, the concentrate business is more attractive than the bottling business. And a lot of times it's like, well, I don't know, where do you start? Right? This gives you a place to start. Okay, well, a more attractive business is likely to have bargaining power over suppliers, bargaining power over buyers. Let's now compare those two and see whether one has more bargaining power than the other. More attractive business have barriers to entry. Well, are there more barriers to entry into concentrate or into bottling? And in fact, concentrate has bigger barriers to entry because not only do you have to get into bottling, but you also have to build a brand, and you have to get slot space in stores. Those are very big barriers to entry. So it turns out barriers to entry are actually bigger in concentrate than they are in bottling. Then you can go through, well, what about threat of substitutes? Are they, can the concentrate makers have bigger threat of substitutes or do bottlers? Well, some people think there's no substitute for Coke or no substitute for Pepsi, even if the other's there, right? Some of you know from your families, it's like, there's no substitute for some people. It has to be Coke or it has to be Pepsi. But, I could put it in plastic or cans or bottles, or there are a lot of different ways I could bottle a soda. And there are more alternatives, okay? So you use that as a framework, as a way to try and diagnose and understand what's going on in a situation. That's how you use a framework. And in the same way you can use the framework here to try and estimate why is this more attractive than this one or that one. All right, so you can do this in different industries. I'm just going to put up two here, one that's low profit overall and then one that's high profit overall. So if we think about airlines, why is airlines not been an attractive industry? Well, what's interesting is even though it's not been profitable, there still is fairly high threat of entry. And the reason is that new entrants sometimes have a cost advantage over incumbents, established players. Why? Because they enter with cheaper labor, and labor is a huge cost in the airline industry. So if you enter with a younger workforce, you have lower labor costs. The other thing is, if you enter with planes, because there's a glut of planes and you can get them cheap because they're leased, or new planes that have better technology to get better gas mileage, things like that, you actually can have a cost advantage as a new entrant going into this market because you don't get the same sort of benefits and economies of scale. Now there are some, and I'm not saying there aren't, and we'll talk about this when we get to the Southwest case. Supplier power, there's typically been strong labor unions. Customers tend to be pretty price sensitive because it's sort of one flight versus another. There are some differences, but it's expensive enough that we're willing to go for the cheaper flight. And there are some threat of substitutes. If the price gets too expensive, people just won't fly, they won't go, or they'll take a train or a bus or drive. So there are other ways to do it. All of those add up to an industry that over the last 50 years has not been particularly attractive or profitable for the average company. Let's compare that with pharmaceuticals. This is the ethical drugs industry. Yes?
So in the airline industry, they had, so when did it become deregulated? Like in the 80s?
It was late 70s,
So
I think.
how did that change, like how would you analyze that? Because that was a serious, that changed the industry significantly. How would that have affected this?
So it made it less profitable for the average airline company. And because they now had to compete. Before that, they were regulated, and that meant that the price was regulated between two cities. It was the same price. And the way they sort of set the price was they took their costs and then they added a little profit, the government, and said, okay, you can make a little bit of profit. So on average, before there was the competition, the way we have today, it was higher profit. So it was a better business to be in before deregulation.
And so that would have made it more difficult to enter.
You couldn't enter in those days unless you got approval from the CAB, which was the forerunner of the FAA. So you had to get approval from them. So you would have a lock on the Detroit to Chicago, or the Salt Lake
Whatever the
to
routes
LA
were.
market.
Okay.
Yeah. And then the other thing was that they then, so if you had two airlines that would fly the Salt Lake to LA market, you had to both charge the same price. And so that's why in those days you couldn't compete on price, and so that's why they would compete on
Service.
who had better meals and who had more leg room and other things like that, because you had to charge the same price. And when deregulation happened, all that went away.
And this is Dr. David Benson, strategy professor. He's the resident airline expert, apparently. he knows, but yeah. So, so let's talk about pharmaceuticals. Okay, a little bit different in pharmaceuticals. If we think about buyer power in particular, how much power do you have to influence the price of your medications? Right? It's kind of laughable, right? They charge whatever, it's almost whatever they want, because in fact most of the time they're granted a monopoly, a patent, on their product for a certain period of time. And the reason they do that is because they want an incentive for those companies to make R&D investments, they come up with new things. So it's sort of a good news, bad news. The good news is they come up with breakthroughs. The bad news is they can charge anything they want for a period of time. And there's really nothing you can do. If you need the product to deal with an ailment, you got to buy it. And you can't be very price sensitive. So in fact, buyer power is low. Supplier power is actually pretty low too, because usually the pills come from commodities. So they're just different chemical combinations that come together. So in fact, there's not a lot of supplier power. If we think about threat of entry, the cost of developing the drugs is now so high, getting them through the FDA. So you need to understand the drug approval process, which is very expensive. And then you got to have sort of the sales and distribution network to get your drug around the globe as quickly as possible, because you got to sell it worldwide pretty quickly, because you want to make back the money that it cost you to develop that drug as quickly as possible, because your patent, the clock is ticking, right? So you want to get it out there and start making money on it as quickly as you can. So you want to get worldwide distribution. That's all very, very expensive, which creates barriers to entry. And in some cases, there's no substitutes. Now, at some point, what we see is when the generic drug comes on, the revenues of the branded drug usually drops by 50% the year after. That's how much you tend to lose, because now you have competition. But during that time, when you've got the patent, you're making a lot more money. So you can sort of take industry by industry, and you can go through each of the forces, and you can sort of rank them low to high in terms of the strength. And that's we actually have a little tool to do that in the chapter 2 on industry analysis, to sort of go and get a sense for whether or not an industry is likely to be highly attractive, moderately attractive, or not very attractive. All right, I want to say one last thing before we break. And that is, Dr. Bryce and I did this study looking at attractive industries over a time period, and this shows the most attractive industries in terms of incumbent return on assets, the number of new entrants, the rate of entry, the entrance ROA, and the profitable entrance ROA. And we were interested in answering a couple of questions. Number one, do barriers to entry thwart firms from attempting entry into profitable markets? And the answer was no. Everybody wants the profitable markets. If you're going to go, you don't want to go for airlines or steel. You want to go for pharmaceuticals or... So in fact, the top 10 most profitable markets have 5 times as many new entrants as the average industry. All right, so so companies, you know, new entrants see an opportunity in attractive markets. That's what attracts them. They try to enter. All right. Now the question is, well, do entrants to the most attractive markets, do they encounter entry barriers? And the answer is, actually they do. On average, you make less money when you try and enter an attractive industry than when you try and enter an average industry. So there's 5 times more entrants. It looks like it's more profitable, but then on average, you do worse. However, if we look at only the profitable entrants into those attractive new markets compared to profitable entrants into any other markets, the companies that crack the code to get around those barriers to entry into an attractive market, those companies actually do much better than average. So if you're Red Bull and you can actually figure out how to get into the beverage business, you'll do better. But you got to figure out, how do I get around the barriers to entry? And that's one of the real challenges that you want to look at. If you're thinking about market entry and you're looking at, we want to grow into attractive industries. So we think about ConAgra, you know, going into frozen entrees. It's, how do we get around the barriers to entry? How does Red Bull get around the barriers to entry? Right? How did Red Bull do it? How did Red Bull get into, yes? They found a niche. So, did they actually try and get into grocery stores? No. Initially, they didn't. It was all nightclubs, bars. It was especially university towns, right? Where there were 20-somethings that wanted to go to nightclubs and dance the night away, and this was going to help them to dance the night away and to stay awake for their tests, right? That was sort of, and they actually created these very cool, they have the thin cans, and they had these things that you could hang on the inside of the bars, and the nightclubs could hang on the inside of their refrigerators, so it wouldn't take up any more space. So they could go in and they could hang them in, and it gave them sort of additional supply that they could sell, but it didn't take up additional space in their refrigerator. So they went to nightclubs, they went to sort of a very different distribution route, targeted on a niche market. And the niche market, turns out, really liked that. And so they grew in the niche market, and then they became popular enough in the niche market that then they had some leverage to go into grocery stores and convenience stores to go in and say, look, we're already selling this many. We already have this many customers. And people may, you know, they try and get customers to go in and ask for it. And then this helps crack open the door to convenience stores and to grocery stores. You try and get around those barriers to entry. We think about Virgin Cola, trying to get into the US market. Well, they had a brand, so you could argue that they could overcome that barrier to entry was brand. But they didn't overcome the distribution barrier to entry. What could they have done? What do you think they could have done to get around that barrier? It's not an easy problem. Yes?
I'm not sure how Virgin functions, but maybe they could have done some type of bundling thing with like their phones. I mean, that might have been weird, but they had some type of supply and some type of distribution already.
So you got to find something. So yeah, they could have done something that would have been very funky, trying to bundle it with phones or some other product. Okay. Yeah. Who else has distribution to stores? They could have maybe teamed up with a beer company that has distribution to stores or convenience stores. They could have teamed up, we talked about Walmart entering because they have their own shelf space. Maybe they should have teamed up with Target, the super Targets, and they could have actually done something, a cool promotional thing with Target, and used their shelf space. So you have to think about, how do we get around each of the barriers to entry? If you want to have a successful entry into an attractive market where there are barriers, first you identify the barriers, and then you got to figure out how do you get around each one of those to have a strategy that's likely to work. Yes?
So you said that that barriers to entry are not preventing people from entering?
From trying.
From trying, but
yeah.
that barriers to entry are what's preventing them from making money, being profitable?
Yeah. Okay. Yeah. All right, that's it for today. Thank you for being here. We'll see you on Monday.